The Hour Between Dog and Wolf by John Coates, book summary in English. Welcome to Power Books. Ever wonder what really drives the decisions of traders? Is it pure logic or something more primal? Inspired by John Coates' groundbreaking book, The Hour Between Dog and Wolf, we delve into the fascinating intersection of neuroscience and trading psychology. We explore the biological forces that shape our choices in the markets. Join us as we unpack the science behind risk-taking, the impact of stress, and how to tame the beast within. Subscribe to Power Books and support our journey to understand the power of the human brain in the world of finance. Let's unlock the science of trading together. Chapter 1: The Hour Between Dog and Wolf. John Coates begins by introducing the central metaphor of the book, the hour between dog and wolf, a French idiom for twilight. He explains that this time of day, when it's difficult to distinguish friend from foe and vision is uncertain, mirrors the ambiguous and often deceptive nature of the financial markets. Coates argues that traditional economic models, which assume rational actors, fail to account for the powerful influence of our biology on trading decisions. He sets the stage for exploring how hormones, neurotransmitters, and our physical responses to risk and reward actively shape our perception of the market and drive our behavior within it. The chapter establishes the core premise that understanding our physiology is crucial for navigating the uncertainties and emotional pressures of trading. Key takeaways. The hour between dog and wolf symbolizes the uncertainty and perceptual challenges inherent in the markets. Traditional economic models often overlook the significant impact of biology on trading behavior. Our physical and neurological states actively influence how we perceive and react to market information. Understanding the interplay between our biology and the trading environment is essential for making more informed decisions. This chapter lays the foundation for exploring the specific biological mechanisms that drive risk-taking in subsequent chapters. Chapter 2: The Trader's High. John Coates delves into the neurobiological rewards associated with successful trading, focusing on the role of dopamine. He explains that when a trader makes a winning trade, the brain releases dopamine, a neurotransmitter linked to pleasure, motivation, and reinforcement. This surge of dopamine creates a powerful trader's high, a feeling of euphoria and satisfaction that makes the winning behavior more likely to be repeated. Coates highlights that while this reward system is fundamental for learning and survival, in the context of trading, it can become problematic. The intense pleasure associated with wins can lead to an overemphasis on seeking that feeling, potentially encouraging increased risk-taking, neglecting risk management, and fostering overconfidence. The chapter illustrates how this biological drive for reward can sometimes override rational analysis and contribute to impulsive trading decisions. Key takeaways. Winning triggers a dopamine release in the brain, creating a pleasurable high. This reinforces the trading actions that led to the win. This biological reward system can become maladaptive in trading. The desire to experience the high can overshadow sound risk management principles. The trader's high can lead to overconfidence and a distorted perception of risk. Traders might attribute wins solely to their skill, ignoring the role of luck. Understanding this neurobiological mechanism is crucial for self-awareness. Recognizing when you might be chasing the high can help you make more objective trading decisions. Developing strategies to decouple the emotional reward from trading outcomes is important for long-term success. Focus on process and risk management rather than solely on winning. Chapter 3: Testosterone Rex. In this chapter, John Coates examines the significant role of the hormone testosterone in influencing risk-taking behavior and aggression, particularly within the competitive environment of financial markets. He presents scientific evidence suggesting a correlation between higher levels of testosterone and an increased propensity for taking risks. Coates explains how testosterone can embolden traders, making them feel more confident and potentially leading them to take on larger or more speculative positions. He also discusses how the hierarchical and often aggressive nature of trading floors can further impact testosterone levels, creating a feedback loop where success can elevate testosterone leading to even greater risk appetite. However, Coates cautions that while higher testosterone might correlate with short-term gains in some instances, it can also lead to impulsivity, reduced fear of losses, and ultimately poor decision-making. Key takeaways: testosterone levels can influence a trader's appetite for risk. Higher testosterone is often associated with increased risk-taking. The competitive environment of trading can impact testosterone levels. Success can lead to a surge in testosterone, potentially fueling further risk-seeking behavior. While testosterone might correlate with short-term gains, it can also lead to negative trading behaviors. Impulsivity and a disregard for risk can be detrimental in the long run. Traders need to be aware of the potential influence of their own hormonal state on their decision-making. Factors like stress, sleep, and even winning streaks can affect testosterone levels. Developing strategies to maintain a balanced and objective mindset, regardless of hormonal fluctuations, is crucial for consistent performance. Don't let testosterone-fueled confidence lead to reckless trading. Chapter 4: The Smell of Money. John Coates broadens the lens in this chapter to explore the often overlooked influence of sensory cues and the surrounding environment on traders' physiology and, consequently, their decision-making. He presents research suggesting that even subtle environmental factors, such as ambient noise levels, lighting, temperature, and the presence of cues associated with success or failure, can trigger physiological responses that impact risk appetite and judgment. Coates illustrates how the sensory-rich and high-pressure atmosphere of a trading floor, with its constant sounds, visual stimuli, and the palpable tension of money at stake, can prime traders for certain emotional and behavioral responses, sometimes operating below conscious awareness. He emphasizes that these seemingly minor environmental factors can contribute to a trader's overall physiological state and subtly nudge their trading choices. Key takeaways: sensory cues and the trading environment can have a subtle but significant impact on a trader's physiological state. These influences often operate subconsciously. Environmental factors can prime traders for increased risk-taking or heightened anxiety. The sights, sounds, and even smells associated with trading can trigger specific responses. The high-pressure atmosphere of a trading floor can amplify physiological responses and influence decision-making. The stakes and the constant activity can create a heightened state of arousal. Traders should be mindful of their trading environment and how it might be affecting their emotional state and cognitive function. Creating a more controlled and calming workspace could be beneficial. Optimizing the trading environment to minimize negative sensory influences can contribute to more rational and objective decision-making. Reducing distractions and managing stress through the environment are important considerations. Chapter 5: The Cortisol Cliff. In this chapter, John Coates focuses on the stress hormone cortisol and its profoundly negative impact on trading performance. He explains how prolonged exposure to stress, such as that experienced during losing streaks or periods of high market volatility, leads to elevated levels of cortisol in the body. This chronic stress response impairs crucial cognitive functions essential for successful trading, including attention, memory, decision-making, and risk assessment. Coates describes the cortisol cliff, a point at which sustained high cortisol levels overwhelm the system, leading to increased errors, emotional reactivity, impulsivity, and ultimately, a significant decline in trading ability. The chapter underscores the critical importance of recognizing the signs of excessive stress and implementing effective stress management techniques to avoid this detrimental state. Takeaways: prolonged stress elevates cortisol levels, which significantly impairs cognitive functions vital for trading. This includes focus, memory, and rational decision-making. The cortisol cliff represents a state of cognitive and emotional breakdown caused by chronic stress, leading to poor trading outcomes. Performance deteriorates sharply under sustained high cortisol. Recognizing the symptoms of excessive stress, e.g., anxiety, irritability, difficulty concentrating, is crucial for proactive intervention. Early detection can prevent a descent over the cortisol cliff. Effective stress management techniques are not just beneficial, but essential for maintaining peak trading performance. Strategies like mindfulness, exercise, and adequate rest can help regulate cortisol levels. Protecting oneself from chronic stress is a key aspect of risk management in trading. Managing your psychological well-being is as important as managing your capital. Chapter 6: The Biology of Bubbles. In this chapter, John Coates synthesizes the neurobiological insights discussed in the preceding chapters to offer a compelling perspective on the formation and bursting of market bubbles. He argues that the same hormonal and neurological forces that influence individual traders' behavior also play a significant role in driving the collective irrationality seen during speculative frenzies. Coates explains how the trader's high, fueled by dopamine and the increased risk appetite associated with elevated testosterone, can create a positive feedback loop, leading to excessive exuberance and the inflation of asset prices. Conversely, the fear and stress response, marked by increased cortisol levels, can contribute to the rapid and often panicked selling that characterizes bubble bursts. By examining market bubbles through the lens of human biology, Coates provides a deeper understanding of the psychological underpinnings of these dramatic market cycles. Key takeaways. Market bubbles are not solely driven by rational economic factors, but are significantly influenced by the collective neurobiological responses of traders. Human biology plays a key role in their formation and collapse. The trader's high, dopamine, and increased risk appetite testosterone can fuel the irrational exuberance and overconfidence that characterize bubble phases. These biological rewards reinforce buying behavior. Fear and the stress response, cortisol, triggered by falling prices, can exacerbate the panic selling during a bubble burst. The biological imperative to avoid loss takes over. Understanding the biological basis of bubble psychology can help traders recognize the emotional drivers behind market manias and crashes. This awareness might offer a slight edge in navigating these turbulent periods. While individual traders may strive for rationality, the powerful forces of collective biology can create self-reinforcing cycles of irrationality in the market. Recognizing this dynamic is crucial for risk management during bubbles. Chapter 7: The Speculator's Brain. In this chapter, John Coates examines the neurological tendencies and cognitive biases that can predispose individuals towards excessive speculation. He explores how the brain's reward system, particularly the anticipation of future gains, can become amplified in the context of speculative trading. Coates discusses how the allure of quick and substantial profits can trigger strong dopamine responses, overriding more rational considerations of risk. He also touches upon the role of cognitive biases, such as the optimism bias, the tendency to overestimate the likelihood of positive outcomes, and the availability heuristic, relying on easily recalled information, often vivid past successes, in fueling speculative behavior. The chapter highlights how these neurological and cognitive factors can create a speculator's brain, one that is wired to seek out and potentially overvalue risky opportunities, often leading to irrational exuberance and ultimately financial losses. Key takeaways for traders. The anticipation of large profits in speculation can trigger powerful dopamine responses, potentially leading to irrational risk-taking. The brain's reward system can be easily hijacked by the allure of quick gains. Cognitive biases like optimism bias and availability heuristic can fuel speculative behavior by distorting perceptions of risk and reward. Traders may overestimate their chances of success and underestimate the potential for losses. The speculator's brain is characterized by a heightened sensitivity to potential gains and a diminished perception of risk. This neurological wiring can make individuals more prone to chasing high-risk, low-probability trades. Understanding these neurological and cognitive tendencies is the first step towards mitigating their negative impact on trading decisions. Self-awareness of these biases is crucial. Developing strategies to counteract the speculator's brain, such as implementing strict risk management rules and seeking objective feedback, is essential for long-term survival and profitability. Conscious effort is needed to override these inherent biases. Chapter 8: The Illusion of Control. In this chapter, John Coates delves into the powerful cognitive bias known as the illusion of control, which is particularly prevalent and dangerous in uncertain environments like financial markets. He explains how traders often develop an inflated sense of their ability to influence market outcomes, even when those outcomes are largely driven by randomness and external factors. This illusion can stem from various sources, including the active nature of trading, making decisions and executing trades, the tendency to attribute successful outcomes solely to skill while downplaying the role of luck, and the human desire to find patterns and predictability in chaotic systems. Coates illustrates how this overestimation of control can lead to overconfidence, increased risk-taking, and a failure to adequately prepare for inevitable losses. The chapter emphasizes the importance of recognizing the limits of one's control in the market and adopting a more probabilistic and humble approach to trading. Key takeaways for traders. Traders often suffer from the illusion of control, overestimating their ability to influence inherently uncertain market outcomes. This bias is a common pitfall. The active nature of trading can reinforce the illusion of control, as traders see a direct link between their actions and market movements, even if spurious. Attributing successes solely to skill and ignoring the role of luck perpetuates the illusion of control and hinders learning from mistakes. The human brain is wired to seek patterns, which can lead to the perception of control even in random sequences of market events. Overcoming the illusion of control requires acknowledging the inherent uncertainty of the market and adopting a more probabilistic mindset. Focusing on what can be controlled, risk management, trading process, emotional responses, rather than trying to control the market is crucial for long-term success. Humility and a willingness to accept losses as part of the game are essential antidotes to the illusion of control. Chapter 9: Addiction to Risk. In this chapter, John Coates explores the unsettling potential for risk-taking in financial markets to become akin to an addiction. He draws parallels between the neurobiological responses triggered by gambling and those experienced by traders, particularly the release of dopamine in anticipation of and following wins. Coates discusses how the intermittent reinforcement schedule inherent in trading, where wins are unpredictable but can be significant, is a powerful driver of addictive behavior. He examines how some individuals can develop a compulsive need to trade, chasing the high of winning and experiencing withdrawal-like symptoms, anxiety, irritability, when unable to engage in market activity. The chapter highlights the dangers of this addiction, including financial ruin, relationship problems, and a loss of control over one's life. Coates emphasizes the importance of recognizing the warning signs of risk addiction and seeking help if necessary. Key takeaways for traders. Risk-taking in trading can trigger similar neurobiological reward pathways as addictive behaviors like gambling. The dopamine rush associated with wins can be highly reinforcing. The intermittent and often unpredictable nature of trading wins creates a powerful reinforcement schedule that can foster addiction. Some individuals are more susceptible to developing a compulsive need to trade, driven by the high of winning and experiencing negative emotions when unable to trade. Warning signs of trading addiction include trading beyond one's means, neglecting other responsibilities, experiencing withdrawal symptoms when not trading, and chasing losses. Recognizing the potential for addiction to risk is crucial for self-protection and maintaining a healthy relationship with trading. Establishing strict trading limits, taking regular breaks, and seeking support if you suspect a problem are vital steps in preventing or managing trading addiction. Trading should be approached as a profession or business, not as a source of emotional highs or a way to escape problems. Chapter 10: The Madness of Crowds. In this chapter, John Coates delves into the biological underpinnings of herd behavior and market manias. He explains how our inherent social nature and the tendency to look to others for cues in uncertain situations can be amplified in the financial markets, leading to collective irrationality. Coates discusses the role of social contagion, where emotions and behavior spread rapidly through a group, often bypassing individual rational thought. He explores how the fear of missing out, FOMO, and the desire for social validation can drive individuals to follow the crowd, even when asset prices become detached from fundamental value. The chapter examines how the neurobiological rewards associated with being part of a winning group and the fear of social exclusion can override individual judgment, contributing to the formation and unsustainability of market manias. Key takeaways for traders. Herd behavior in markets is partly rooted in our biological predisposition to seek social cues and conform to group behavior, especially in uncertain situations. Social contagion can lead to the rapid spread of emotions and trading behaviors within a market, often overriding individual rational analysis. The fear of missing out, FOMO, and the desire for social validation are powerful drivers of herd mentality, pushing individuals to follow the crowd into potentially overvalued assets. The neurobiological rewards associated with being part of a perceived winning group reinforce herd-following behavior. Resisting the madness of crowds requires conscious effort, independent thinking, and a strong sense of one's own investment or trading strategy. Developing the ability to detach emotionally from market hype and focus on objective analysis is crucial for avoiding the pitfalls of market manias. Understanding the biological basis of herd behavior can help traders identify potential bubbles and make more rational decisions, even when the crowd is moving in a different direction. Chapter 11, The Price of Stress. In this chapter, John Coates details the significant physical and psychological toll that prolonged stress, a common companion in the high-stakes world of trading, can take on individuals. He revisits the role of cortisol, the stress hormone, explaining how its chronic elevation not only impairs cognitive functions crucial for trading, as discussed earlier, but also has detrimental effects on physical health. Coates outlines the potential links between chronic stress in trading and increased risks of cardiovascular disease, weakened immune systems, digestive problems, and other stress-related illnesses. Psychologically, prolonged stress can lead to anxiety, depression, burnout, and a diminished quality of life. The chapter serves as a stark reminder that the intense pressures of the market can have serious consequences beyond financial losses, emphasizing the critical need for traders to prioritize their well-being and implement effective stress management strategies for long-term health and sustainability. Key takeaways for traders. Prolonged stress in trading has significant negative consequences for both physical and psychological health. It's not just about financial outcomes. Chronically elevated cortisol levels, a hallmark of sustained stress, can increase the risk of cardiovascular disease, weaken the immune system, and contribute to other physical ailments. Psychologically, persistent stress can lead to anxiety, depression, burnout, and a general decline in well-being, negatively impacting trading performance and personal life. Ignoring the signs of stress and failing to implement coping mechanisms can have severe long-term health implications for traders. Prioritizing stress management is not a luxury, but a necessity for longevity and success in the demanding field of trading. Effective stress reduction techniques such as exercise, mindfulness, adequate sleep, and healthy relationships are crucial for mitigating the price of stress. A sustainable approach to trading must incorporate strategies for managing stress and maintaining a healthy work-life balance. Your health is your most valuable asset. Part 3, Taming the Beast. Chapter 12, The Mindful Trader. In this chapter, John Coates introduces the concept of mindfulness as a powerful tool for traders to manage risk, regulate emotions, and enhance decision-making. He explains how cultivating present-moment awareness without judgment can help traders become more attuned to their internal states, their emotions, thoughts, and physiological responses as they interact with the volatile market environment. Coates argues that by observing these internal signals with detachment, traders can gain greater insight into how their biology might be influencing their decisions, allowing them to step back from impulsive reactions driven by fear or greed. Mindfulness practices, such as focused breathing or body scans, can help to interrupt the automatic stress response and create a space for more considered and rational action. The chapter emphasizes that by becoming a mindful trader, individuals can develop greater self-awareness and improve their ability to navigate the psychological challenges of the market. Key takeaways for traders. Mindfulness, the practice of present moment awareness without judgment, can significantly enhance a trader's ability to manage risk and emotions. Cultivating self-awareness through mindfulness allows traders to observe their internal states, emotions, thoughts, physiological responses with greater clarity. By noticing these internal signals without immediate reaction, traders can gain insight into how their biology might be driving impulsive decisions. Mindfulness practices can help to interrupt the automatic stress response, creating a space for more rational and considered actions. Becoming a mindful trader involves developing the capacity to detach from emotional fluctuations and make decisions based on a well-defined strategy rather than immediate impulses. Regular mindfulness practice can lead to improved emotional regulation, reduced reactivity to market volatility, and enhanced focus and concentration. This chapter offers practical strategies for incorporating mindfulness into a trader's routine to foster greater self-control and improve trading performance. Chapter 13, The Physiology of Calm. Building on the previous chapter's introduction to mindfulness, John Coates delves into specific techniques that traders can employ to actively reduce stress and cultivate a state of calm composure in the face of market pressures. He emphasizes the importance of understanding the physiological mechanisms of the stress response and how to counteract them. Coates explores various methods, including controlled breathing exercises, which can directly influence the autonomic nervous system, shifting the body from a state of fight or flight to rest and digest. He also discusses the benefits of physical exercise in dissipating stress hormones and promoting overall well-being. Furthermore, the chapter touches upon the role of adequate sleep and a healthy diet in maintaining physiological balance and resilience to stress. Coates argues that by proactively managing their physiology, traders can build a foundation for clearer thinking, better decision-making, and improved emotional control, ultimately leading to enhanced trading performance and long-term sustainability. Key takeaways for traders. Actively employing techniques to manage your physiology is crucial for reducing stress and maintaining composure during trading. Controlled breathing exercises can directly influence the autonomic nervous system, helping to shift the body into a calmer state. Regular physical exercise is an effective way to dissipate stress hormones and improve overall physiological resilience. Prioritizing adequate sleep and a healthy diet plays a significant role in maintaining hormonal balance and reducing vulnerability to stress. Understanding the physiological underpinnings of the stress response empowers traders to take proactive steps to counteract its negative effects. Cultivating a physiology of calm contributes to clearer thinking, improved focus, and better emotional regulation, all essential for successful trading. Integrating these stress reduction techniques into a daily routine is an investment in both trading performance and overall well-being. Chapter 14, The Rules of the Game. In this chapter, John Coates shifts the focus from internal physiological states to the external framework of trading rules. He argues that establishing and, crucially, adhering to a well-defined set of trading rules is a critical strategy for taming the beast, managing the impulsive and often irrational behaviors driven by our biology and the chaotic market environment. Coates emphasizes that rules provide a predetermined framework for decision-making, reducing the influence of real-time emotions like fear and greed. He discusses the importance of rules covering various aspects of trading, including entry and exit criteria, position sizing, risk management, and trade selection. The chapter highlights that the act of creating these rules forces a level of conscious thought and planning, while the discipline to follow them builds consistency and helps to override the potentially destructive urges stemming from our neurobiological responses to market fluctuations. Key takeaways for traders. Establishing a clear and comprehensive set of trading rules is essential for mitigating the impact of emotional and biological impulses on decision-making. Well-defined rules provide a predetermined framework for entry, exit, position sizing, and risk management, promoting objectivity. The process of creating trading rules forces conscious thought and planning, leading to a more strategic approach to the market. Adhering to trading rules builds discipline and consistency, helping traders to avoid impulsive actions driven by fear or greed. Rules act as a circuit breaker, interrupting the automatic responses triggered by market volatility and our internal physiology. Regularly reviewing and refining trading rules is important, but deviating from them in the heat of the moment often leads to negative outcomes. The rules of the game provide a necessary external structure to help traders manage their internal beast and navigate the inherent uncertainty of the market. Chapter 15, The Long View. In this chapter, John Coates advocates for adopting a longer-term perspective in trading and investing as a powerful strategy to mitigate the potentially disruptive effects of short-term hormonal fluctuations and emotional responses to market noise. He explains that the daily and even hourly swings of the market can trigger significant physiological responses. The dopamine rushes of small wins, the cortisol spikes of losses, which can lead to impulsive and often detrimental trading decisions. By focusing on a broader time horizon, traders can smooth out these emotional peaks and valleys, allowing for more rational and strategic decision-making based on fundamental analysis or longer-term trends rather than immediate market reactions. Coates argues that a long-term view encourages patience, reduces the urge to overtrade, and helps to detach from the short-term biological and psychological roller coaster of the market, ultimately leading to more sustainable and potentially more profitable outcomes. Key takeaways for traders. Adopting a long-term perspective can help to mitigate the impact of short-term hormonal fluctuations and emotional responses on trading decisions. Focusing on longer timeframes reduces the intensity of the physiological responses triggered by daily market swings. A long-term view encourages patience and reduces the urge to overtrade based on short-term noise. Strategic decision-making based on fundamentals or long-term trends becomes more prominent when a longer time horizon is adopted. Taking the long view helps traders detach from the immediate emotional roller coaster of the market, fostering greater objectivity. This approach can lead to more sustainable and potentially more profitable outcomes by avoiding impulsive reactions to short-term volatility. Developing a long-term mindset requires conscious effort and a focus on the bigger picture, rather than getting caught up in daily market drama. Chapter 16, The Future of Risk. In this concluding chapter, John Coates offers his broader perspectives on navigating risk in an increasingly complex and interconnected world, drawing upon the biological and psychological insights explored throughout the book. He reflects on the inherent human tendencies that can lead to both great innovation and catastrophic failures in the face of risk. Coates emphasizes the importance of integrating our understanding of human physiology and cognitive biases into our models of financial markets and decision-making processes. He discusses the implications of his findings for regulation, risk management, and the development of more resilient and sustainable economic systems. Coates suggests that by acknowledging our biological wiring and the potential for irrationality, we can design better safeguards and cultivate a more mindful and balanced approach to risk-taking, not just in trading, but in all aspects of life. He leaves the reader with a call to action, to embrace self-awareness, and to build systems that account for our inherent human nature in order to navigate the uncertain future more effectively. Key takeaways for traders and beyond. Understanding human biology and cognitive biases is crucial for navigating risk effectively in an increasingly complex world. Traditional models often fall short by assuming perfect rationality. Integrating neurobiological insights into financial models and regulations can lead to more robust and resilient systems. Acknowledging our inherent tendencies is key. Self-awareness of our physiological responses to risk and reward is paramount for individual traders to manage their behavior and make better decisions. Developing strategies to mitigate the negative impacts of our biology, such as establishing rules and adopting a long-term perspective, is essential for sustainable success. The principles discussed in the book extend beyond trading, offering valuable insights into risk-taking in various domains of life. The future of risk management lies in acknowledging our human nature and building systems that account for our inherent strengths and weaknesses. Embracing mindfulness and a balanced approach to risk are crucial for navigating the uncertainties of the future, both in the markets and beyond. And that brings us to the end of our exploration into the fascinating world of trading psychology, inspired by John Coates' The Hour Between Dog and Wolf. If you found this deep dive into the biology of risk-taking insightful, please give this video a like. Share it with your fellow traders and anyone curious about the science behind our decisions. We'd love to hear your thoughts. What resonated most with you? Leave a comment below. Don't miss out on our future explorations into the powerful books that can transform your understanding of the markets and your own mind. Hit that subscribe button and the notification bell so you're alerted whenever we release a new PowerBook summary. If you're eager to delve even deeper into the science behind risk, hormones, and the trader's brain, you can find a link to purchase the full book, The Hour Between Dog and Wolf, in the description below. It's a truly eye-opening read. Thanks for joining us on PowerBooks. Keep learning, keep exploring the power within, and we'll see you in the next video.